Hello, we're going to demonstrate how to distribute money in an equity joint venture using return of capital. Before you is a scenario of a 2-year investment that we will follow throughout this tutorial. I strongly encourage you to pause now, write the scenario down, and practice going over yourself before we walk through it together. First step is we need to know how much money we have to distribute or how much money we need to raise at the beginning. The line item that's very important here is equity before tax cash flow. So the first thing we do is run through the property details to calculate the unleveraged cash flows and our debt cash flows, and then the difference between those two is our equity before tax cash flow. If that's new to you, please go back and review the videos associated with debt cash flows. Our focus here is what we do with that equity before tax cash flow. How do we distribute that between two partners in the equity investment? The model I'm going to use here is called return of capital. To help you out, I'd like you to think of an analogy of this structure is very similar to how money is distributed in an amortized loan. Think of the equity before tax cash flow in every period as representing the payment that we would make on the loan or on the equity agreement. Think of the pref, the preferred return, as the interest rate that we promise to our outside investors or LPs. And think of the return of capital step as pay down of the principal or the debt investor's stake in the original investment. In this case, we're going to pay down the equity investor's stake in the original investment. So we're going to go through a 3-step priority. And this is very similar to how it would work in an amortization table. The first step, we're going to pay off the prefs, the preferred returns. So again, we're going to pay off the interest first. This is the interest earned off the money invested in the joint venture during that period. Now, contracts do vary here. Sometimes you pay off all of the limited partners, the outside investors, first before the sponsor general partner receives a single dollar, or you pay them pari passu simultaneously. The contract will tell you all. If there's money left over after paying the prefs out to all of the equity partners, then the remaining money is distributed as a return of capital. It pays down the initial investment stake taken by each partner. And this is almost always pari passu. But sometimes there is contracts where you just pay down the outside investors first and the limited partner doesn't receive any money. In that case, they will likely not receive any money till the very end of the deal. If you have a situation where you've returned all of the money that was originally invested to the outside investors and to yourself, the sponsor, anything left over is distributed according to the promote structure, or the more common term, the waterfall. And this is where the sponsor tends to earn a promote above pari passu for their success in earning excess returns above the pref, above the preferred return. And in this situation, the return of capital, that waterfall is sort of dammed up during the entire investment, and the floodgates open on the sale of the asset. So you normally here have a big, giant, gushing waterfall at the very end with no promote structures, no waterfalls during the holding period because generally you don't pay back all of the initial capital invested with the income returns. So these structures are popular where the limited partners want the strongest incentive for the general partner to maximize the sale or the reversion price of the asset. In the table at the bottom, you see a summary of cash flows to each investor's parties based on the steps. And again, you see that waterfall only flows on the sale period. Now, to get that table, we actually have to calculate the individual cash flows first. So we're going to switch over to Excel, and I will show you how we distribute the money to each of the two parties. So here's the deal structure again. 90% was contributed by our limited partners, our outside investors, 10% by us, the sponsor, the general partner. We promised an 8% preferred return, and once the waterfall flows, we as the sponsor get a 20% promote. Priority of distributions is going to be pref is paid pari passu until the return is fully paid to both parties. Then money left over goes to return of capital, again pari passu, and any remaining money after we've returned all of the capital to both parties is in the waterfall. And that would be distributed with that 20% promote, which means 70% of it goes to the outside investors, 30% to the sponsor. Again, strong incentive to get that money flowing in the waterfall. So what we're going to do here is we're going to go period by period. So we have 3 periods. The first period is the initial capital raising. How much money do we need to raise right away, and who pays that $500,000? So pari passu again, or this establishes what pari passu is. So we have 90% raised by the outside investors, which means of $500,000 needed, they stump up $450,000. Our sponsor, us, the expert in the deal, raises $50,000. So at the end of period 0, right, there's no other money changing hands. We've just raised equity capital. The capital invested at the end is the same as it is in the beginning. Now this is important because in return of capital, we're going to pay back part of that initial investment over the course of the investment. So we have to keep a running total of the capital account, or how much we owe, or sorry, how much each equity investor has in terms of their initial capital invested in the deal. So that was period 0, fairly simple, straightforward. Period 1, we have some income. Hooray! Now, how do we distribute that $61,000 between our 2 equity investors? The first thing we need to do is pay the prefs. So these outside investors are going to earn 8%, or the pref, on the capital that they have currently invested in the deal. Much like you pay interest rate on the outstanding principal in a loan. We promised them 8%. So our outside investors will receive a payment of $36,000. Our sponsor will receive a payment of $4,000. So that is 8% on the money that they had currently invested. Now let's see how much we've just paid out. So that takes $40,000 of our money that we have to distribute. So what's left over? $20,887. And that money is going to be distributed as a return of capital in our second priority here, which I've colored pink, which says pari passu until all capital is returned. So I'm going to distribute 90% of that capital to my outside investors. And I'm going to distribute 10% of that money to me, the sponsor. And that takes care of all the money. Right? There's nothing left over because our investors have not received all of their capital back. And what we need to do now is calculate their current capital account, or how much they have invested at the deal now that we've paid back some of their initial investment. So my sponsor here now only has $47,900 left in the deal. My outside investor has $431,202 left in the deal. So now we move to phase 2, or period 2, sorry. Now we've we had another year of income, plus we've actually sold the asset. So we have a big equity before tax cash flow here to distribute, but the formula is the same. The first thing we're going to do is pay 8%, the pref, on the money that each investor has invested. In this case, it's going to be slightly less because those investors had received capital back. They've paid down their principal or their equity investment. So the pref payment is not as big for the subsequent periods because of that return of capital. So in our second period, our pref payment is less, as expected, because there's less invested capital. We now have $541,000 left to distribute. Now, if I was to distribute that much like I did before, notice that we would be distributing more money to the outside investors than they had invested. So in this case, we're actually able to complete our return of capital on the investors. So in this phase, we pay them back. Likewise, we pay our outside investors back what is outstanding, so that the capital invested at the end is going to be nothing. Now, you'll notice we still have money left over. So we are now, let me make sure that this adds up. Always a good idea to do this. So now we have $579,000 less the pref, less our return of capital. So we have a waterfall. So this $62,000 is now distributed based on the promote agreement. So this is where the sponsor earns a promote. They want this number to be as big as possible because they get an outsized proportion of those returns. So this waterfall is now distributed with a 70% promote for the sponsor, or you can call it a demote for the outside investors. So they are only going to receive 70% of this final return, or $43,000, whereas the sponsors will receive 30%. Remember, the sponsors only put 10% in on the deal, so this is quite a good return on their investment. And now we've distributed all of the cash flows based on the agreement. We can sum up the cash flows that occurred, which is the initial cash flow for period 0, but also for the interim periods, the cash distributed from our 3 phases of distribution. So here for the sponsor, remember, we've distributed the money in the colored cells. Now what we can do is calculate the IRRs for each party. And we see, indeed, the flowing of that waterfall has been a good windfall for our sponsor, our expert, and they have made quite a significant gain in return relative to their outside investors. But of course, remember, the outside investors were promised 8%, so they're pretty happy earning 12.5%. Everybody's happy. It's been a great deal. I hope you followed along. If you've got any questions, get in contact with me. In our next video, we'll cover a different distribution scenario, the return on capital. Thanks for watching.